Hey, check this out. Uh, you're not going to like this, but McKinsey said it. McKinsey caught wind of what you've been saying about the metaverse. So it put out its report. And you know, McKinsey, they're very intelligent over there. Metaverse could be worth $5 trillion by 2030.
Okay. I hate the second word in that headline. Because
Why do you hate it? It's honest.
I can write any headline, and as long as I put that second word "could" in there, it's factually correct. Could be factually correct.
You know, it's funny too. The headline is Metaverse could be worth $5 trillion by 2030, which is for sure the dude who wrote this. That's how he framed it. Because then the first sentence of the article, it starts with global spending in the metaverse could reach $5 trillion by 2030.
Could, yeah, could tells me nothing, right? Could tomorrow the whole world could die. The whole world could cease to exist. Yeah, I could lose my job tomorrow. Like, yeah. Anything could happen. Data. Anything could happen. Tell me what will happen.
Oh, Brett, dude, come on, man. Don't be that guy.
Oh, that's yeah, and then because they're gonna come back and they'll be like,
I'm gonna email all your clients and make sure that you're only allowed to say absolute statements.
That's what they want. The market could go up tomorrow. It could go down. Great, Brett. Thank you for that. That's really helpful.
That's what your clients say to you all day. Hold on, but listen, hold on. This is interesting. McKinsey used data to predict that the future of consumer behavior in the metaverse will most likely be divided into 5 primary activities: gaming, socializing, fitness, commerce, and remote learning. You see, it's not all just
your kids gaming. Already going to have difficulty dating because you got to do everything now online. Now you can't just meet somebody in the real world, but swipe right to get them and get to know them. Now
I wouldn't know anything about that.
Go into the metaverse to find somebody and then hope that they live anywhere close to you, or you just have an online relationship with them.
It's a little bit of like the what's it called? NIMBY stuff. Not in my backyard.
No, it's not doing that. No, I'm not the old guy saying this is a dumb idea.
You're not the young guy saying it's a.
Hey, Marcos, it could be a bad idea.
That sounds like a reasonable statement.
I'll do nothing.
Welcome to episode 19 of Chart Your Chart. I am Marco Segura here with Brett Horowitz. Brett, I'm starting us off with taxes.
Ooh.
I know, I'm sorry. Why taxes? Because inflation would be too easy and Federal Reserve would be too easy. Jerome Powell, I'm glad I don't have his job. So let's shift the conversation to things that we have more control over, which is taxes.
Well, in reality, we don't have much control over that because Congress sets that, but I see where you're going.
Okay, fine, man. Thanks, dude. Great start. My charts. I have 3 of them because I break the one chart rule every single time. So why am I bringing these up? First of all, let's look at 2 sides of the tax ledger. You have federal income tax rates and capital gains rates. So the first 2 charts are line graphs that show the highest marginal income tax rate and capital gains rates since 1913 and 1922. So a real long time. Why are we showing this? Because right now is a pretty good time historically to be paying taxes, given where we've come from.
Yeah, they've been lower, but they've been awfully higher. I mean, I can't imagine the days where you had tax rates of 90% and thinking, why the heck am I working if 90% of my money could go to the US government?
Yeah, exactly. Check this out. I did not appreciate this. From 1940 to 1963, the highest marginal income tax bracket was over 80%. Oh my Lord. Imagine what people are arguing about now. Think about that, right? That's marginal. Important point. This does not mean obviously that all of your income is taxed at this rate. This just means the last dollar of income, that highest amount, wherever the bracket kind of split, that's where you'd get hit, right? So as an example, in 1952, I don't know who the president was, maybe you did, you were taxed 92% on the last marginal dollar of income.
That's just federal, right? I mean, I'm not sure. I imagine states had tax rates at that time as well.
Yeah, I'm sure. I guess right now no one would live in California if that's how that worked.
It's awful. I mean, you have to really challenge yourself to say, why am I going to keep working if I'm going to bring so little of that money back with me? right? So I know we talk all the time to clients who either have a big investment or have a capital gain or they're selling a business and they say, oh my God, I'm going to pay so much in taxes. You're keeping most of your money that you're making on those investments right now.
Yeah. So this is why I bring that up, right? So rebalancing is a thing that we adhere to. It's one of our tried and true disciplines that we're unapologetic about. We're going to do that. What rebalancing means is two things. As you know, it means that when markets fall, we're going to take advantage and buy them, right? We did that back in May to the tune of a certain percentage of client portfolios. Things have gotten cheaper. If they keep getting cheaper, we'll do it again, right? That's us taking advantage of low prices. But we also do it on the opposite side, right? So when markets hit all-time highs, we're doing it again. We're trimming stock positions that say down. What might that cause, Brett Horowitz?
Taxes.
Taxes, exactly.
Why? We had a lot of clients earlier in the year, and the entire firm did it, where people needed to refill their cash. People were getting low on how much they had in cash on their bucket on the side. And so we freed up a lot of money in January, which turned out to be, wasn't any kind of skill. It was just luck that it happened then. But we got out a lot of money early on. So a lot of clients, even though their portfolio was down, they still have a capital gain for the year.
Of course, and you stick to your disciplines, right? And that's what happens over time. At the end of the day, if we had that crystal ball that we don't have, then none of this would matter. But since we don't know what's going to happen, all we can do is fall to the level of our disciplines and our process. That's all we have. In an environment where all we're doing is navigating uncertainty, all we have is our process. Our process says we rebalance. So we rebalance when markets are high. What happens? Taxes. What's the other issue with taxes? A lot of times they come not always when the market is doing the best. So a lot of times you get this interesting relationship where the gains happened years in the past, but you're paying the taxes now. What you think about it is kind of nice because you've deferred the taxes for a little bit of time. And now we're not going to try to take every single capital gain we can. We'll do it as thoughtfully as possible, but you got to pay the piper at some point. And we always joke, you might want to put smiley faces on all the zeros when you write your check to the IRS, because it means you made money.
Yeah,
right?
we have the expression that we tell all of our clients when they first become a client. We have no control over the market. We do have some control over when you pay taxes and how much expenses you pay on your various investments. Yes. And we've seen over the last 5 years, clients had massive gains in their portfolios, but a lot of times they didn't pay any taxes. So I would say it's sort of the best of both worlds. You made a lot of money and you didn't pay a lot of money to the government. But as you said, at some point, you've got to pay that money. So whether it's in the year you made money or down the road, that money's gonna be paid unless you don't ever have to sell because either the portfolio stays in balance or you never need cash.
Exactly. And ultimately, if you never, ever, ever rebalance, you're still going to have to pay some taxes in the form of capital gains, distributions, dividends, interest, all that type of stuff. But then you get an allocation that's totally out of whack. And then you end up with no plan that makes any sense whatsoever. So you have to pay your taxes. It's not that you're never going to pay them, that you don't owe them. You do owe them. We just do our best to time it. That said, if you look at, I think it was 2021 that we did realize a reasonable amount of taxes for clients. This year, it's kind of been the opposite. What's important to realize is for us as planners from a tax standpoint, when we put the tax hat on, we don't just look at 1 year. We're also considering all the years that have come before that. Because what do we do, Brett Horowitz, when the market gives you lemons? What's the lemonade that we try to make? Is losses, right? We tax loss harvest within the portfolio to try to bank those capital losses for clients. We're doing it right now. We're doing it not just for future portfolio gains, but because clients have sold homes, because clients have sold businesses. Anything that we can do to keep more money in their pocket, every dollar that we bank in a capital loss, well, they've saved the tax rate times that dollar, right?
So let's explain this concept just real briefly for viewers so they understand what this loss harvesting is. So this is basically, you've got a fund that you bought for $100, it drops to $75 or $80, and that loss is sitting there unused. So if you did nothing, you just have that in your account and you'd wait for it to go back to $100 and you just would do nothing. Versus our strategy of saying, we're going to take that $20 loss, sell that position, but rather than sell it and do nothing, we're going to buy back an almost identical position so that you stay in the market, right? You don't want to be out of the market after having sold that $20 loss. And that way you can use that $20 loss against future gains or get other gains in other places. Or if you can't find the gains, at least offset $3,000 of income each and every year.
Exactly. And it's not to be confused with the amount that you can offset against your ordinary income, which is only up to $3,000. Let's say you have $50,000 of capital losses. If you have no capital losses this year, you can take your 3,000 against ordinary, but you don't lose it. I've had some clients and friends who've thought that you lose it if you don't use it this year. Not how it works at all. You can actually keep it in perpetuity until you have gains to net against those losses.
Right.
So it's literally an asset in your pocket that eventually will be used, assuming you have a CPA that's properly working with us to make sure that you're accounting for these things and not letting them be forgotten.
I mean, I will ask clients who have six-figure losses, well, how much are those losses? Because some clients say, don't take the loss, I have enough. Well, I want to know how much your losses are, because I want to compare that to how much gains unrealized you have in the portfolio. So I have clients that have $250,000, $500,000 of losses. But you know what? Like you said, that house that they're looking to possibly sell, maybe he's going to eat all of that up. Or the next 30 years, in their life, they'll eat that up. So I'm not going to avoid taking losses just because they already have losses, because at some point it can get used. And I don't want to get in a situation where at some point in the future, they have to start paying gains.
Exactly. Here's another important point of tax loss harvesting. We get to control which lot we sell. What does that mean? When you buy a position, let's use a random US stock market position. You've bought that, you've been a client of ours for 10 years, you bought that a ton of different times. We don't necessarily have to try to sell the one that you bought first or last. We can look across all these different windows of purchases and see which one has a loss in order to help you take advantage. Why do I bring that up? Because you, listener, viewer, are not going to do that. And that is why Brett Horowitz and Marco Segura are productively employed. Why do we bring it up? Because this is the thing you get to control. You get to choose if you look for these things. So instead of complaining about realizing losses in your portfolio, focus on, are you making an attempt to focus on the things that you can actually do to help prevent capital gains thoughtfully? And yes, that is one of the things, as the nerds in the room, that we focus on. So I wanted to make that point about rebalancing and then tax loss harvesting.
I think the worst part in all this is that people are paying their 2021 taxes in April or May or June or whatever of this year. At the same time, the market is down and their portfolio is down. So I think it's affecting their confidence, affecting their, optimism with how things are doing. Just sort of like a double whammy this year. I'm paying taxes and I'm now losing money. This is awful. And so I want to change the topic over to consumer confidence, because that's going to be my chart. And I think we all know that the consumer and our clients are really being hit, several different ways this year, from higher gas prices to higher inflation, to higher interest rates, to, just the war that's happening out there, to politics, to, different decisions in the Supreme Court. So obviously confidence is getting busted a little bit. And where do we see that play out? We see that play out in spending, right? You would say, go ahead.
Eventually, it's going to play out in spending. So you read my mind as far as the spending piece. There's another thing, right? The wealth effect that is hitting everyone now. Even if I don't plan to spend my 401k for 30 years, there's a behavioral psychological wealth effect that comes into play when your 401k balance is down 15 to 30%.
Exactly.
Right. Not to mention that cryptocurrency account that is not doing so hot right now. And what happened to Robinhood, I have no idea. It's crazy. So the wealth effect, just meaning all the assets that were ballooning in value are now X amount of percentages lower than that. I have a natural behavioral inclination to reel it in.
Well, as of last week, this is before this big pop we had in the market last week. I was shocked to hear this couple of stats. 54% of stocks in the S&P 500 were below their pre-COVID value, which is like crazy considering how much better the world is in. How many people have jobs and are spending and how packed things are. In addition, 40% of S&P 500 stocks are at a 52-week low. I mean, that is just mind-numbing compared to where we were 52 weeks ago, where things were just perfect, right? Everything was going up. Maybe too much. Maybe that's the problem. So you're right. Yeah. This is what's causing that wealth gap.
Right. The problem was that Zoom, the thing that we're using right now, was worth more than ExxonMobil for a moment of time. And that seems weird.
So it makes sense why People see their 401ks down. They see their balances down. They hear that R word recession almost every day, if not every other day. And so you're naturally saying, well, I'm going to maybe take that trip and maybe downgrade a little bit. Maybe I'm going to put off that trip or that car or whatever it may be, the house project, the kitchen that you want to do.
I'm going to give you one stat on this because you bring on the individual stocks, and someone talked to me about Robinhood today. Robinhood achieved a highest value of $40 billion of market cap in August of 2021. August of 2021. What do you think the market cap is now from 40 billion?
10.
7.9.
Yeah.
Oh my gosh.
I mean, it's ugly and consumers feel it. And so that's why I've got this chart today. And I'm going to take the bearish case on this, but here's a chart of consumer confidence.
Okay.
The last 50 years, the University of Michigan takes this survey. They say, how good are things or bad are things compared to a year ago? How good or bad are they compared to what you think will be next year in terms of you financially? How do you feel in terms of saving and the economy and your spending and so forth?
Okay. I'm noticing something as I'm looking at this chart, Brett Horowitz, and it makes sense. It feels pretty contrarian as an indicator.
That's one way to look at it for sure. Go ahead. So make your case.
So look, I'm not going to use the whole smart money, dumb money in the room, right? But I will use that. I believe one of the permanent truths of any life is that although market circumstances can change, the market participants don't behaviorally. Behavior is consistent. We still have these hunter-gatherer brains that haven't received an update in a pretty long time. And when everyone is just saying things could never get worse, well, then what's left to get worse? And what happens? And I think, brother, if you charted the S&P on this thing, I bet you there'd be a pretty meaningful contrarian point to make that when this is the lowest, let's be buyers.
Well, you can see the blue numbers or the black numbers. I'm sorry, with the old consumer confidence. Every time it got into the 50s, you had a double-digit rally in the stock market over the next 12 months. So most of the time that happens.
Yeah.
I think, though, the one worry that I have is that we haven't seen yet job losses to any big degree. I think everyone's expecting that to happen as rates go up. I'm concerned, and a lot of consultants are concerned, that inflation may not come down as fast as we think it's going to come down, which means the Fed has to keep raising rates really, really high, really, really quickly to try to get out in front of that, even if they can't, change the supply issue very much. And so that's going to lead with even more problems. You're going to have people spending less, companies going to make less, earnings come down, prices come down, and it lasts far longer than we've seen so far.
Yeah, and I'll bring it full circle. And we were wrong. Remember the inflation predictions that we made? That I don't think those worked out so well. My inflation worry is that there's two components to it. I guess three. There's a supply side, the demand side, and then the wage side, right? So the wage price cycle, like that spiral, that's real. The Fed can hurt demand. The problem with that is that's painful, because that literally just means that they want unemployment to go up, right? We can make it as like academic as we want to. The reality is they want markets to crash and they need people to lose jobs. That sucks. That's going to be painful for a lot of people in the US. It stinks. The issue then becomes, I agree that inflation could still keep running hot because there's a supply issue that's yet unresolved, which is, of course, now the new word, right? Last year's word of the year was transitory, and then this year's word will be stagflation. Let's get crazy renewed interest since really the end of last year, but now you have the barbers of the world, so to speak, talking about stagflation.
Well, I'll bring it back to maybe argue against myself one last time here, which is that something that you mentioned before we started our call, right? Let's say that all of my predictions are correct and that things get worse before they get better, which certainly could happen. To me, that's a much shorter term play. And if a year from now, this chart plays out properly and the S&P is now positive, that means you've made up, in this all these cases here, a double-digit return over the next 12 months. So maybe I'm not so worried about another 5 or 10% drop if over the next 12 months, I'm going to get a 15, 20% increase.
I hear you. And it could happen. What could also happen? I'm going to bring up a chart and look at. So I'm going to go global financial crisis. I'm going to go tech bubble, right? You're going to get you might get bear market rallies. In the global financial crisis, you had rallies of 8%, 12%, 7%, 18%, and 24% before we hit bottom. And in the tech bubble, we had rallies of 8%, another almost 9%, 19%, 21%, 20%, and then another 20% before we hit bottom.
I talked about this last time with 73, 74, the same thing. You had all those fake rallies.
Not good, but I'm invested and I'm a buyer.
Yeah, I mean, to your point, I think we see this chart. It looks pretty obvious what we hope is going to happen. But, you know, there's always things that stand out where just like, yeah, the trend is this, but it doesn't happen. So you can't say this is a guarantee by any stretch of the imagination. I know you love that word, but I'm not going to use it here.
Okay, fine. Guaranteed.
Let's keep our fingers crossed at least.
Yes, sir. Watch a Nick Cage movie.
Take care, Marcos.
See you, BH.
Bye.